Welcome to another episode of Kuvera Insights, where we talk to industry leaders on how you should be managing your money. Today we have two very esteemed guests with us. Pooja, who is the assistant editor and an avid podcaster with Forbes India. She runs two successful podcasts at Forbes India, one called Capital Ideas and the other one called From the Bookshelves of Forbes India. She writes on private equity, high finance, and the Indian economy. Welcome, Pooja, to the show. We also have Anup, who is the Chief Investment Officer and the Joint CEO of IIFL AMC. He is an alumnus of IIM Lucknow and has over 25 years of investment experience. Prior to IIFL, he had stints as the CIO of equities at DSP and also the CIO at HSBC. In the past, he has been featured amongst the top equity fund managers in the country. So welcome, Anup. So starting with Anup, right, for someone looking to time market moves, right, what would be your advice? I mean, is it possible? Can you do that on a daily basis, on a monthly basis, even on a business cycle basis?
So the interesting thing is, over the last 24, 25 years that I've been investing, this question has come up permanently, literally from that I joined this industry. Is this the right time to invest? What returns can we get? And what's the downside here? I mean, these three were standard questions you'd get in different ways, but essentially those are the three questions. And interestingly, over the last 24, 25 years, there's always been something to worry about. As they say, markets climb walls of worry. It's just that everything that you worry about changes over time. We've seen enough over the last 24 years, which looked really ominous for markets and kept playing on people's minds from a timing point of view. But eventually, markets are where they are, and a lot of these events come and go, essentially. So what we realized is that it's really very futile, was our learning over time, to try and assess every event and come out with a very long-term market view based on that. Most of this is hindsight analysis. A lot of us also, because we're in the market, we're expected to explain what happened on hindsight, and we all study it and sound like experts at the end of it. But it's all hindsight, explaining a situation that has happened. The ability to predict something is very low, actually, because new things keep happening. So essentially, just given all of this context and the point that a lot of time is spent in asking these questions where, frankly, there are no good answers to, we thought we'd actually try and provide some perspective to it through a slide that we call time, volatility, and returns, to answer those three questions of, is this the right time? What returns can I get? And what risk do I carry? So as I mentioned, so 3 points were related to timing, returns, and the risk, or how much downside, which we measure as volatility. So we said 3 variables: time, return, volatility. Let's throw that onto a chart together and see what it sort of tells us. And what we came up was with this chart, which is a relationship between time, volatility, and returns. And I'll just explain this very quickly. So on the x-axis, you'll see that there are different time periods: 1 year, 2 year, 3 year, 5 year, 7 year, 10 year. And these represent periods of time, rolling periods of time on the Sensex. So we took data running all the way back, essentially from 1990. So it's about 30 years of data. And we've plotted different periods of time and tried to plot returns and volatility on them. So the blue line that you see is the returns line, and the yellow line is the volatility line. Now, when you look at the blue line, I think what's interesting is it's for the most part between 10 to 15% across different time periods. And just to explain exactly how we got this number, I'll just maybe explain it to you with the 1 year number. So the 1 year number, you'll notice, is about 14% on the Sensex. So what we've done is we've gone for every day of the last 30 years, we've calculated a 1 year return. So you've got that many data points of 1 year returns for every single day of the last 30 years. And then you take the most commonly experienced number out of that at the median, and you plot that as the number. So the most commonly experienced 1 year return, 2 year return, 3 year return, 5 year return, 7 and 10 year return, and that gets plotted out as this blue line. And the most consistent experience is somewhere between 10 to 15%, as you can see from the graph. The volatility line, though, is a very, very different picture. The 1 year volatility is as high or north of 35%. So right up front, it tells you two very clear things. Number one, if anyone gives you a 12-month view, please take it with a big pinch of salt, because with 35% volatility, it's almost impossible to get it right. There are just too many events in the short run that you won't be able to predict. And at least in my 24, 25 years, I haven't come across anybody who's been able to consistently predict the market in sort of 12-month cycles. So that's number one. So, 12-month views, you'll get them a dime a dozen, but please, take them with a pinch of salt. The second thing it tells us is actually equities is probably not an asset class worth even investing into from a one-year point of view. Because why would you buy something which has a median return of about 14% with 35% plus risk attached to it? If you look at it in risk reward terms, it's 2:1 against you. So why would you buy something? Normally the principle should be in any investment you make, you want a risk return in your favor. But interestingly enough, what you will observe through that graph is as you start pushing out the time horizons, the yellow line keeps coming down, the volatility line keeps falling, whereas the return line is still fairly consistent. And from the little under 6 years onwards, the return line is actually consistently ahead of the volatility line. So the interesting thing is just mathematically, a lot of people also ask us, what is long-term investing? How do you define it? Different people have very different definitions. But just from a pure risk reward point of view and mathematically looking at the last 30 years, what it has suggested is that 6 years and above tilts the risk reward of investing in your favor, at least as far as the Indian market is concerned. If you look at mutual funds, it's actually a slightly better picture than this. We haven't plotted it here, but on average, I would assume most mutual funds would have beaten the index over this time period, 30 years, and probably in the vicinity of about maybe 2 to 3% above the index returns with similar levels of volatility. So if you sort of extrapolated a mutual fund graph onto this, the cutoff period for this risk reward to be in your favor would probably be about 4.5 years or so. And interestingly, if you look at all the good funds, or most of them, and especially where I spent the bulk of my time, my previous employer, we never had a single period of time where on a 5-year basis we delivered a negative return. Even if you invested at the absolute worst point of the market, over a 5-year period, at least you came out with a positive return. So 5 years and above, the risk reward starts working more in your favor from a mutual fund point of view, and about 6 years from an index point of view is the basic point to make here. And this actually, in fact, what we normally tell investors, therefore, is that the returns are pretty straightforward. In fact, that's the easier part to gauge for markets, because corporates want to create value over time. That's the whole idea of running a business. So value will get created. The challenge is really navigating the volatility to get to that return. So what happens is, the blue line is what is sold to everyone, or everyone comes in with the perception that this is what I'm going to get from it. But you have to live through this yellow line of volatility. And most people actually get knocked off just with the volatility alone, because volatility can be good or bad. If you're lucky, it adds to your returns. But most people actually experience the negative side of it because they come in normally when markets are already higher.
So that's definitely one part of the equation. And when you have, you of course have tons and tons of people who read Forbes India, and you guys write about this a lot. What kind of questions do you mostly get? Are investors more interested in, what's the hot stock, what's the hot mutual fund, where should I invest, what's going to work out in the next 6 months? Or are they asking more questions around asset allocation and goal planning, and kind of, understanding that it may not be impossible to trade, but there are costs involved which you have to pay, starting from bid offer all the way to taxes.
True. A lot of people who send us questions, first and foremost would be, do we stick into what we have, or do we sell it off? I mean, do we sell it off? Do we stick into what we have? And second thing is, these days, and also if we look at a lot of data, everybody's been talking about how a lot of retail investors are sitting at home and trading these days. And if we see, I mean, if you look at yesterday, if you look at today, if you look at this week at least, markets have been falling considerably. And now people are hoping, oh, it'll come down. Let's wait till 35. And when market hits 35,000, maybe then let's put in capital. So a lot of these questions are quick fix questions. Do I invest now? Do I now exit mutual funds because mutual funds haven't really performed well over the years? And now can we just get into the whole index fund culture? Or should we also look at, again, making a quick buck? I mean, I think the concept over the last few months have been, can we make a quick buck because it is rallying? I will be able to get in and get out. What if somebody else can't? But I can definitely get in and get out. That's one of the kind of feeling that we've been seeing that people have.
Like, it's like saying if Tesla has gone up 8x in 1 year.
Yeah, exactly.
Why do I need to compound
you can't really
14? Why do I need to compound at 14%? So to your point, right? So we are actually doing some quantitative analysis on our own right now, and about the stocks versus mutual funds. And we find it very interesting because whether you own a stock portfolio or whether you own a mutual fund outright, you're still owning a stock portfolio. So we looked at the Nifty 100 stocks, right? And we said, okay, what if you ran a stock SIP? Forget a mutual fund SIP, right? You don't believe in mutual funds. We understand that. So let's run a stock SIP. Every month you buy the same stock, 10,000 rupees for 3 years. The average stock SIP would have returned you like 3.4% in the past 3 years. That's what your XIRR would have been. Your index XIRR is closer to 4%. So I think I find that argument sometimes very entertaining when someone says that mutual funds, which is just a basket of stocks at the end of the day, you're calling it, or ETF, which is again just a basket of stocks at the end of the day, will not make you money, but stocks will make you money. So it's almost like saying, okay, at the ingredient level, it's really good, but the meal will turn out to be bad. So how do you guys handle that? I mean, how do you handle these questions? When you get these questions about people inquiring on, 35,000, like how do you say whether that's a good number or not?
You really can't say that. The best part you can talk about to them is the fact that you have to look at long-term investments and what is your personal goal. Some people have these goals like I need to save capital for my daughter to go to college or for my daughter to get married, etc. People have their separate goals. For example, if I'm looking at if I want to go to college, if there's somebody 20, I remember this question coming up from someone. He wanted to go to college after a few years and he had X amount of money, but he was looking to go to US for his studies. So obviously he needed 3x more than that. But you can't tell anybody you can make 3x and you should do these 4 stocks and you'll be able to do 3x and that's how you can pay for your college. That's absolutely not really happening in a lot of places. But what we can suggest to them is that if this is your goal, these are some of these stocks that have performed over the years. This is a 6-year, 10-year view, and then if you would like to take that view, that's your obviously personal call. But it is quite impossible to imagine that nobody can really time the markets. You have to just keep going with the flow.
So the biggest challenge actually of investing is more psychological and behavioral. I think there are enough smart people who can figure out businesses, who can look at valuations and all those sort of stuff. I think it comes down to temperament eventually to a large extent. And, serious long-term investing, as they often say, is like watching grass grow or the paint dry type of thing. So, the lesser the activity, the better actually it is for you. But that doesn't appeal to everyone because you have daily prices, you have movements, you have news channels blaring things out all the time. So all of that sort of incites action. So the only thing that you could do, frankly, if you have to, somewhat want to be involved somewhere in that, is to very clearly compartmentalize the two. It's a bit like our portfolios. When we even construct portfolios, we actually have different compartments in our portfolios. So the way we treat, let's say, cyclical businesses is very different from the way we treat defensive businesses. We like to buy and hold defensive businesses, but we may want to trade a little bit more actively in a cyclical economy sensitive business, for instance. So you follow a pretty much similar approach with your portfolio, which is, you define what is your long-term, or, the part that you will just park. And, you can define a small corpus for you to act, but just make sure they don't mix at any point in time so that temperamentally you're not, juxtaposing one view against another. So that's typically, maybe one potential way of doing this. But most importantly, I think when you're investing, the first thing to assess really is your risk tolerance. The returns, as I said, still come by. That's not an issue. The question really is, how much risk can you handle? How much of a drawdown can you handle? And that really determines.
If I can interject there, right? How do we decide which risk bucket to kind of start you on?
Yeah, so I mean, listen, everyone who comes into the market, by the way, starts off as a long-term investor in their minds, and then you realize, once you go through a bout of volatility, really what your tolerance is from a long-term point of view. But having said that, I think the question really is, how much can you afford to lose? That's pretty much it. How much impacts your life dramatically based on taking a loss? I think when you enter equities, just because it's the volatility that you have to live through, I think the first question is, how much of a loss tolerance can you take without it dramatically altering your lifestyle? And if that capital, if tomorrow it got eroded, then if it's going to put you back too much, maybe that's not the amount of capital that you should have exposure to, for instance. And to our mind, the biggest drawdowns that we've seen, just to try and put some numbers, and I'm just thinking off the top of my head here. If you look at the last 40 years of investing in India, the biggest drawdowns, they've been, drawdown is what we define as a 35% or more correction in the index. There have been 7 instances in the last 40 years, including the one that happened in March. So it's not something that happens very often, but when it does happen, you can lose a fair amount of capital at an index level. At stock levels, it can be even worse, but at a broad level, we're talking of about a 35% drawdown. And we've seen that, that's the sort of tolerance that you have to effectively come in with. So can I afford to lose 35% of my portfolio, assuming I've just come in at the worst possible time? And can I sit through that and still manage to keep it going for myself till the time it comes back? If I can't tolerate that, then probably, it's not the place to be. Or at least you have to adjust your exposure accordingly.
Fair enough. Pooja, you've been tracking investment for a very long time, right? Is there something that you've seen that works? And anything that you think that, okay, maybe at a macro scale, you can make an argument that, markets are 95% efficient, blah, 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 blah. But there are certain opportunities available if you're smart or if you're, if you want to be more active. And do you personally think that is it easier to select stocks versus selecting mutual funds, or it's equally hard? It doesn't matter.
First, I'll come back to the one point that you said before. You talked about how mutual fund is a basket of stocks versus what you're picking is a single stock that you're picking. I think the problem is that, over the last few years, for example, I started doing mutual fund SIPs when I started my career in 2008. So when the markets tanked, it was my first SIP. So maybe I was quite lucky to get into a time when everything was down, and then that's when I started. So I believe that you can always make money. But the problem is, in the last 12 years, what I've seen is that a lot of our mutual funds, if you go back and just run an Excel on all the mutual funds that you have in your portfolio, and you will see that your returns, the older ones would give you around 12-13% post-tax also. And then there are some over the last 5 years which have given you a return like 1.2%, 3.2%. And that's when you think, how do I deal with this return versus what I used to get? So then you think, okay, maybe the fund manager doesn't know what he's doing. Let me take things in my hand and let me decide my own future. So I think that has also happened a lot, because people believe that, why am I paying a fund manager? You're taking money from me to manage my capital. I am not a rich investor. I am just a small time investor trying to do my SIP with you, and yet you can't make money. Aren't you supposed to make money for me? So my point was, let's just take things in my hand and let's just decide what to do with it. And so firstly, one is, as I told you, sipping in your entire stock. For example, you can't have like 20, like I don't promote, I'm not going to say you have 20, but if there's one company that you like, or you identify a few, 1 or 2, which is what I've done, I found 2 or 3 companies which I believe in, and I believe that they are going to do well over the next 5 years, 6 years, 7 years. Some of them are banks, some of them are companies that I think are okay. So then whenever they go a little down, you feel comfortable around it. just go buy it, just keep buying it. And maybe in 5-6 years it will perform. And if it does not perform, I am to blame myself rather than blaming someone whom I don't know at all.
Because effectively what's happening is, what we are seeing is that a lot of these Robinhood traders are not people like you who have done this for a very long time, who at least understand finance, who are working in the financial industry. Majority of them are thinking of this as, hey, you know what, this stock never goes down kind of a deal. So let me keep buying it all the way up. And everyone always has this confidence that, you know what, yeah, it'll fall someday, but I'll be the first one to sell.
So, when we used to show this to people, another question was, it doesn't sound terribly exciting, right? 10 to 15% returns, and I've got to live through this volatility. So was there any way to improve this blue line, or to push the yellow line down, the volatility line down, and the blue line, the return line up? So what we observed was that, markets, there's zones of risk reward. You can never find a top or a bottom, obviously, but you can find zones where the odds are beginning to get in your favor or against you. And what we observed is, we use price to book. We don't use PE multiple, because earnings can be extremely volatile in the short run. And like in a year like this, there's nothing to really go by. But price to book is a very consistent indicator. And what we observed is that whenever the market gets to 2 times price to book or below, and this happens rarely, so this is the last 20 years, this has happened 1, 2, 3 times. This is the third time it's happened. Whenever the price to book comes below 2 times, effectively it's only 5% of the time of the last 20 years has the market been below 2 times price to book. And the 5-year returns from there have been 40%, which is way in excess of what you would benchmark for equities. Now, it may take time. So for instance, this looks very simple on a chart, but you had to survive this for a year and a half of markets going nowhere. But the zone was right for you, and then you'd make supernormal returns eventually. For the most part, markets are between 2 and 4 times price to book. So 52% of the time it's between 2 and 3, and 31% between 3 and 4. And right now we are at about 2.7. So we're somewhat in the range where your returns are more in line with the average, that blue line that I showed you. And conversely, as you keep going higher, above 4 times price to book, we actually raise a red flag at 3.5 times onwards, because we've observed that around 3.5 also the risk reward starts changing. But 4 times and above, the market doesn't spend too much time there, and your future returns are way below even fixed income returns. So that's the range we normally say. If the market's at 4 times price to book and above, that's a damn good time to start thinking about your asset allocation. It's almost certain you'd be very bullish at 4 times price to book, and everything you'd be hearing would be good. That's just the nature of things. And you'd be tempted to invest, and you would have seen a lot of money being made by others already. And therefore, let me put some money in this, some quick money to be made. But that's where you lose. Those are those big wrong decisions. And close to 2 times price to book or below is where the fear is maximum, the uncertainty is maximum, everything looks bad to you, but that's the time you will end up making money. So just following the simple price to book on the market itself, to our mind, is a very good indicator for you to be able to just assess whether you're setting yourself up for a big loss or for a big gain. And for the most part, there's nothing much you can do between 2 and 3 times or 3.5 times price to book. You just say, listen, I can't catch every 10, 15% fall. So forget it, I'm just staying the course. And that's really, to our mind, the best way of investing, at least looking at the past. I can talk about listed equity funds. They have track records. You've got a lot of good listed equity funds with 20, 25-year track records of 18%, 20% CAGR, which is better than you get from most companies. So I sometimes wonder why mutual funds really have got as bad a name as they seem to keep having from time to time. Given the fact that over really long periods, they've actually done exceptionally well. The challenge really is that people come and go, and invariably will come and go at the wrong time, and therefore their experience from mutual funds. When you look at the weighted average returns on the flow into mutual funds, it's a very different number than what any mutual fund will show you on paper as its point-to-point returns over a 20-year period. That's the challenge. I'll give you one example since we're talking about it, and I'm going to quote from my previous employer again because I spent most of my working life there. So we used to manage a fund called the DSP Equity Fund, and this was launched in 1997. In 2017, when we completed 20 years, the fund had delivered close to a 20% CAGR over 20 years, right? So it was an outstanding return. You were up, some 60 times or something from whatever you invested in. And when we completed 20 years, we thought, let's just go back and maybe write thank you notes to everybody who's been with us on this entire journey. And when we went back to see how many investors stayed with us from 97 to 2007 to 2017, I think there were less than 20 people of the folios we were managing. And some of those people were people who had forgotten they even held the units. That's the only reason why they lasted 20 years. So that just shows you how markets in a way are designed to knock you off from long-term investing, because it's going to keep throwing news at you, analysis at you, fear at you constantly. And you're going to try, and every time you try and respond to a stimuli like that, the chances are you're just going to stray off path. We always say this: the risk is actually entirely in the control of the investor. From that chart that I showed you, if you just give it time, the risk dissipates automatically and you participate in what you came in for, because businesses do grow over time. But if you're going to try and time a business every year, you're not going to be capturing the business cycle. You're just capturing the volatility. That's what you're playing. Then you might as well, whether you're in a casino or the stock market, really doesn't make a difference.
Having predictability in losing money is as hard as having predictability in making money. So if someone can say that, I am a claim saying that I'm the worst investor in the world, that everything I buy, I lose money in. Effectively, you're saying is that I need to buy everything else except what you have bought, and I'll actually beat the index. So people always, these examples, they're fun examples that, and pretty sad for the person who invested in multiple PE funds and lost in all of them. But having predictability as a bad investor is actually equally valuable to a asset management company as having predictability as a good investor, and both are equally hard, right? So both are. If you know of friends who have consistently lost money in stocks, I would love to talk to them and find out how, because that might have some value as well. It's not easy to do either ways. Having said that, I think this was a fantastic discussion. I think there are certain, of course, behavioral biases that kind of push us to invest more. I think Pooja made a very interesting point that people are a bit disappointed. They expected a certain amount of performance from their mutual funds, from the index funds, or from the ETF or whatnot. Even PMS for that matter, because I hear roughly the same argument for PMS is also, and then people are then saying I'll take matters in my own hand. I hope that it turns out well for everyone. We know from experience that stock picking is it's not easy. It's definitely not easy. India is a very competitive stock pickers market. So we'll probably get some more data in a couple of years on how that pans out. But thanks for coming on the show, Anup. Thanks for coming on the show.
Thank you so much, Gaurav. It was fun. Thank you, Anup.
Thanks, Gaurav. Thanks, Pooja.